While the world was distracted by the cacophony of 24-hour news cycles and political theater, the most powerful financial entity on the planet quietly pulled the trigger on a $2 trillion exodus. This isn't a rumor, a conspiracy, or a clickbait headline. We are witnessing a monumental migration of hard capital, orchestrated by an institution that manages more wealth than the GDP of almost every nation on Earth. BlackRock, the silent landlord of global capitalism, has begun a massive rotation, shifting trillions of dollars right under our noses. This move signals the dawn of a historic wealth transfer, one that will leave reactive investors in the dust while rewarding those who understand how to follow the footprints of the giants. To understand the gravity of this moment, you first have to understand the scale of the player. BlackRock isn't just an investment firm, it is the infrastructure of the modern economy. With over $14 trillion in assets under management, they don't just participate in the market, they are the market. If the global economy is a skyscraper, BlackRock owns the land, the steel, and the lease on every floor. When they move, the earth shakes. And right now, Larry Fink and his army of analysts have decided that the traditional American-centric playbook is no longer the fastest path to growth. This decision isn't based on emotion or patriotism. It is based on cold, hard mathematics and the shifting tides of global policy. Recently, BlackRock reallocated $2 trillion of exposure away from the United States and toward emerging non-US markets. Let that number sink in. $2 trillion has been packed up and moved out of the American economy. Now, this doesn't mean the United States is collapsing. It means that the era of easy gains in the domestic market is evolving. Money, like water, always seeks the path of least resistance and highest growth. For the last decade, that path was the S&P 500. But the winds are changing. Retail investors, the average person checking their phone once a day, tend to react to headlines. They buy when things look safe and sell when the news looks scary. But institutions move before the headlines are ever written. They have data sets that cost millions and insights that go deeper than any public report. The secret to building generational wealth isn't having their data, it's watching their hands. We don't need to know what they say, we need to see what they do. By the time the mainstream financial media explains this rotation to you, the opportunity will be gone. The profit will have been harvested. Markets do not reward loyalty, they reward positioning. If you are still holding on to the America-only strategy out of a sense of tradition, you are essentially flying blind into a storm. Let's look at the scoreboard, because the numbers don't lie. Last year, the S&P 500 delivered a respectable 16% return. In any normal year, we'd be thrilled with that. But while Americans were celebrating 16%, the rest of the world was sprinting ahead. Germany's market returned 22%. Japan's markets surged by 26%. International markets as a collective whole returned nearly 30%. Why is this happening? It's the double win of currency and growth. When the US dollar weakens, foreign assets receive an automatic boost. Think of it as running a race with a powerful gale at your back. You aren't just gaining value because the company you invested in is growing, you're gaining value because the currency that company operates in is becoming more valuable than the dollar in your pocket. This is the tailwind that big money is currently chasing. We are currently facing a perfect storm of policy risk, currency pressure, and a massive outflow of cash. Last year alone, $48 billion in foreign capital fled the United States. They didn't leave because they hate America. They left because they found a more efficient engine for their capital. So, where is this money going? And more importantly, how do you position yourself to catch the wave? To navigate this, we have to look at three specific vehicles that the smart money is using to hijack this global growth. The first pillar of this strategy is the Vanguard Emerging Markets ETF, known as VWO. This is essentially a passport to the world's most explosive economic engines: China, India, Brazil, and Taiwan. The logic here is simple: demographics. While the West is aging, these nations are powered by young, hungry populations. These are people who are just entering their prime working years, building families, and consuming products at an accelerating rate. In the investment world, demographics are destiny. Last year, VWO returned 25%. Currently, the price action is quiet, but for a seasoned investor, quiet is a luxury. Professional institutions don't buy when a stock is vertical, they accumulate when the world isn't paying attention. Buying into emerging markets right now is like buying the US stock market 20 years ago. It's a long-term play on the next generation of global superpowers. The second pillar is one that often catches people off guard: Japan, via the EWJ ETF. For decades, the narrative was that Japan was a stagnant, dead economy. That narrative is officially obsolete. Japan is currently undergoing a massive structural reset. They have overhauled their corporate governance, forced companies to become more efficient, and, most importantly, started prioritizing shareholder returns. When you combine this internal reform with a weak yen, you get a money-printing machine for Japanese exporters like Toyota and Sony. Their products become cheaper for the world to buy, and their profits skyrocket. This isn't just a recovery story, it's a total reimagining of how Japanese business operates. The institutions see it, and they are pouring in. The third pillar is the broader Emerging Markets Fund, EM. This is the tool of choice for macro investors who don't want to pick a single winner. They are betting on the buffet of global growth. Last year, this fund returned 34%. It's a bet that the collective world will outpace the United States as we move into a multipolar economy. With places like Singapore and India growing at breakneck speeds, the EM fund spreads your risk while keeping you tethered to the fastest-moving ships in the harbor. But as we talk about these shifts, we have to address the psychology of the market. Every global rotation feels uncomfortable before it feels obvious. It feels scary right now because you're seeing headlines about trade wars, political volatility, and global tension. But remember this: certainty is the most expensive thing in the world. By the time the all-clear signal is given, the price of admission will have doubled. BlackRock isn't waiting for certainty. They are playing the probabilities. While the average person is waiting for the news to tell them it's safe to invest, the architects of capital are already building their positions. This isn't about abandoning the US market. You should never operate out of fear. The US will continue to lead in AI, defense, and high-tech innovation. But ignoring the fact that $2 trillion is moving elsewhere is a risk you cannot afford to take. There is, however, another move happening in the shadows, one that involves the oldest form of wealth: gold and silver. For decades, the banking elite treated gold like a pet rock, a useless relic of the past. But recently, the rules of the game changed. Gold was reclassified as a Tier 1 liquid asset. In plain English, this means banks like JP Morgan and Goldman Sachs can now count gold as the equivalent of 100% cold, hard cash. They can use it as collateral for massive loans. Suddenly, gold isn't just a hedge against inflation, it's a financial weapon. This is why we are seeing gold hit all-time highs. It's not just about fear, it's about utility. The world's largest banks are hoarding it because they've changed the definitions to suit their own leverage. They are moving the goalposts, and they didn't send you a memo. To survive this, you have to understand the panic playbook. Have you ever noticed that the most terrifying news always seems to break on a Friday night or a Saturday morning? That is not an accident. The powers that be want you to sit at home for 48 hours, stewing in anxiety, watching your social media feed fill with doomsday predictions while the markets are closed. They want you terrified by Monday morning so that when the opening bell rings, you sell your shares for pennies on the dollar just to make the pain stop. Then, like clockwork, by Wednesday or Thursday, the narrative shifts. Rumors of productive talks or new negotiations begin to surface. The market rallies. The crisis evaporates. And the institutions that bought your panic-sold shares on Monday are laughing all the way to the bank on Friday. It is a game played entirely on your emotions. The system is engineered to keep you overstimulated and reactive. The algorithms, the red flashing numbers, and the breaking news alerts are all designed to give you a traumatic experience with your money. They want you to feel your heart race when you look at your account. They want you to act on impulse. But the secret to winning this game is simple: resist the urge to react. Settle down. Close the app. If you are feeling fearful, you are already losing. You don't need to predict the future to be successful. You just need to follow the footprints in the sand. Position yourself early, stay patient, and let the global system do the heavy lifting for you. While everyone else is paralyzed by the noise, you should be focused on the signal. There is one final piece to this puzzle. While the broad markets are rotating, there is one specific sector that thrives on this exact type of global chaos. It isn't tech, and it isn't real estate. It's a sector that historically outperforms the S&P 500 by double digits whenever geopolitical tension hits a fever pitch. Right now, institutions are pouring billions into it because they know that in a world of uncertainty, certain, hard industries become the only safe harbors. The window to get in early on this rotation is closing. The $2 trillion has already begun to move. The double win of currency and growth is already in play. The question is no longer, what is happening? The question is, where will you be standing when the dust settles? Don't be the investor who waits for the news to confirm what the smart money already knew 6 months ago. Don't be the one who sells on a Monday morning because of a weekend headline. Be the one who recognizes the shift, understands the math, and has the discipline to stay the course. The greatest wealth transfer of our lifetime is happening right now, in silence. It's time to stop listening to the noise and start watching the money.